Hello, my name is Iker Zubizarreta. I'm CFO at FLAR, Fondo Latinoamericano de Reservas. This session will be in English. I will be making a small announcement in Spanish. La sesión va a ser en inglés. Para traducción en Zoom, por favor, seleccionen esta opción en su pantalla. Si necesitan asistencia, por favor, usen la herramienta en el chat y podremos atenderlos. Welcome to this fifth edition of our Cartagena Talks. In these times in which we unfortunately cannot meet in person, this is a space especially created to foster the communication and collaboration within the official institutions of our region. We are grateful that you were able to make time to accompany us once again. We hope that you're safe, effective, and in good spirits. This session is being recorded. Please ask your questions in the chat tool in Zoom, and Marco will be asking them to Arnab. And please include your name and your institution. As you may recall, in our first encounter, we visited China and Asia. In our second session, we spent time in Europe. In the third meeting, we took a closer look at the United States. And in our fourth session, we spent our time in Latin America. And in this special occasion, we have a very special guest in this fifth encounter. We're going to make it through these challenging times. This pandemic will eventually end. And what is certain is that our planet will be quite different. And to that effect, our guest today will help us gain perspective and make sense of our world in the years ahead. Our host for this fifth edition of our Cartagena Talks is Marco Ruiz. Marco, a longtime friend of ours, is an engagement manager for the Research Advisory and Management Partnership, RAMP, within the World Bank Treasury, where he coordinates the delivery of technical assistance to official institutions that want to improve their asset management practices. We are very excited and grateful to Marco and also to the World Bank for their support to this initiative that aims to connect and to foster open collaboration in a region, Latin America. I am very much looking forward to this session. Without any further ado, I leave you with Marco. Marco, the space is all yours.
Good morning, Iker. Good morning, everybody. It is a great pleasure for me to join you again. Unfortunately, we cannot be in person, but and unfortunately not in Cartagena. But it is for me a great pleasure and a great opportunity to get to talk to you and get to have the same discussions virtually from our homes at the moment. So as Iker said, this is the idea is that we're going to focus this session on the long-term trends and long-term global implications of what's going on, and trying to figure out. Probably we're going to end up at the end of the session with more questions than answers, but that's part of the idea, just to generate the discussion. So without further ado, I introduce now Arnab. He will cover a lot of these issues. Then I will proceed with some questions of my own, and then we will get questions from the audience and to keep this discussion going until we complete the allotted time. So Arnab, please go ahead.
Thank you, Marco. Thank you, Iker, and thanks to everyone, to FLAR, for having me here and for joining in this discussion. So I hope I can live up to the billing of telling you where we're going in the long run. Just to tell you a little bit about myself, I do global economics and strategy at Invesco, based in London. Before Invesco, I worked with an economist called Nouriel Roubini, who may be known to some of you. Nouriel is notorious for having predicted the global financial crisis and was known as Dr. Doom for predicting financial Armageddon. When I worked with him, I like to think we predicted the Eurozone crisis, for which I was known as Deputy Doom. So, you have to take everything I say with a grain of salt in that context. I'm actually an optimist by nature, but I think it's fair to say that, that the challenges posed by the pandemic are such that all of our optimism is going to be called into question, at least to some degree. Although I think we are going to get through this, and we're going to have a very different world, as Iker said. So I'm going to take you through a discussion about what I call a great compression, very different than a recession or a depression. What I think the recovery will look like in this alphabet soup that everybody has been discussing for some months now. I call it a square root recovery. We went straight down in this great compression. We're having a bit of a reopening rebound now, but then, and even now it's already starting to happen, that the recovery will sort of level off as various kinds of balance sheet constraints, debt constraints, and also constraints in public health from the pandemic start to bite. And then, of course, there's the real long run question: what is the new world order going to look like? I call it a cautious new world order and a multipolar one rather than a bipolar kind of Cold War one, in which I think the pandemic is going to have accelerated a number of forces that were already in train, particularly the so-called Fourth Industrial Revolution. Okay, so in summary, I was going to say that I think we are going to be coming out of this kind of shared compression in which most of the world economy went down either together or in very quick succession. I think we're going to be coming out of it in a very divergent way because the lockdowns didn't really respect or respond to national economic characteristics or fiscal space or other kinds of policy space, whether it's public health or monetary, but responded to our kind of shared vulnerability as human beings, as a species of animal affected by a new so-called zoonotic virus, right? So we all shared the downturn, but in the upturn, the differences are going to come through. So I think we're going to have a lot more diversity in recovery than we had in the downturn. And I think that diversity is going to continue in the longer term as these forces of structural change in the world economy start to take shape. And I think one important investment implication of that is that diversification should make a lot more sense, not just theoretically, but actually as a practical matter in the long run, because with these barriers created by differences in national economies and barriers that are going to come from, that are already in place and going to continue to come, I think, from some of the geopolitical and geoeconomic tensions that are very evident in the world, we're going to see different models as well as different growth rates, different growth models. And so diversity will be an important kind of buzzword and theme, in my opinion. Okay, just to spend a few moments on the pandemic. I think we all probably have spent too much time trying to be amateur epidemiologists recently, and I'm no exception to that myself. We've had a number of conference calls with prominent public health specialists and epidemiologists, some of them for clients and some of them for ourselves at Invesco. I think it's fair to say that where we are now is that there's a pandemonium still around the pandemic, lots of different things going on around the world. The main organizing principle seems to be that although the data from China show that China has largely conquered the coronavirus, that is not the case in most of the rest of the world. In many developed and emerging market countries, we have rising caseloads. I would say that against that, the good news is that fatality rates, hospitalization rates seem to be plateauing in most places, not all. In my native country of India, it's still going up. And I think it'll continue to do that. We can talk more about that if you want in the Q&A, but I think that's the basic message, that we are not really emerging from the first wave in the summer in many parts of the world. We're having secondary outbreaks within the first wave, but the good news is that the fatality rates are declining. Now, moving on to this great compression, as I call it, I think it's fair to say that this is very different than a recession or a depression in many ways, some of which are obvious and some of which are perhaps a little more subtle. I would say that in a recession, a normal sort of garden variety recession is caused by a major central bank, often the Fed, tightening to squeeze inflationary excesses out of the system, and occurs gradually over time. Depression occurs, I would suggest, because we have policy that is too tight for too long. So we get sequential financial crises or financial stress, at least, and therefore multi-year declines in output and permanent scarring. In this case, we've shut everything down or most things down all at once and shifted a whole range of activity from what was taking place more or less naturally to artificially requiring people to do only essential work or work from home. And I think that explains why we have this pattern that you see first in GDP across countries. On the left-hand side chart here, you see that the stringency of the lockdowns was very closely associated with the degree of depression or compression, as I call it, in the economies across the world. Regardless of structure, regardless of the size of the state, regardless of how much was services, manufacturing, consumption, investment, etc., regardless of all of that, it was largely a function of the strictness with which activity was shut down. That's the chart on the left-hand side, Q1 and Q2. That's what we saw.
Yes, we're experiencing a bit of trouble with Arnab's audio. Maybe Marco, I don't know if so far you have seen anything in line with you were going to be asking. This concept of the square root recovery is in a way sobering, but I don't know what thoughts may you have in that subject while we wait for Arnab.
Sure. Well, I think that's one of the questions or the first question that I wanted to ask Arnab while he's back. It's actually the question of how we're coming out of this, given that this crisis is very unprecedented and basically we're facing a huge crisis, but it's not. I mean, but the measures that have been taken so far are very unconventional.
We have Arnab's video again. Let's see, Arnab. Let's see if we have your audio. Okay.
Can you hear me now?
We can hear you perfect.
Okay.
Sorry
about that. I'm not sure what happened.
Yeah. Sorry, Murphy always takes time to visit. So.
Okay. Okay. So let's get us back on track. Okay, so I think this is where I was when the audio stopped. I had suggested that we had a shared kind of joint rate compression that was largely a function of the lockdowns, how stringent and how long they lasted. But now in the recovery, we're starting to see a great deal of diversity as countries decouple from the lockdowns and from each other. And part of that story, I think, is about the policy response and the policy space that different countries are employing. So here you see the evolution of the major central bank balance sheets over time, and you can see that there's an enormous amount of diversity there. Even though all the major central banks have eased quite sharply, the Fed had been the most active and done the most on balance sheet size, the fastest among the major central banks. Even in fiscal policy, there's been an enormous response, but it's very different across countries. And it's very different as well compared to the fiscal response to the 2009 global financial crisis. So what you see here is on the left-hand side, comparing the 2020 fiscal response scaled against 2019 GDP to the 2009 response across the national members of the G20, right? So you see that there's an enormous difference from, by some calculations, over 40% of GDP in Japan to something like 14 in the case of the US, to as little as 1% of GDP in Mexico, right? So a great deal of diversity in how much discretionary fiscal support is being provided. This is a set of estimations of the fiscal response that excludes automatic stabilizers and excludes loan guarantees and deferrals, right? So it's direct fiscal spending and revenue measures that are above the line across countries. And you see on the right-hand side, the same information arranged as a share of global GDP, right? So this, I think, should give us some hope and confidence that there will be a global recovery, right? The scale of the fiscal response is over twice as large, over 2.5 times as large, actually, as in 2009. But the diversity of that response, both as a share of national GDP and global GDP, is very extreme, right? So I think that's another reason why we're going to see quite divergent performance across countries as we come out of this, this downturn. We tried to make some very simple kind of naive projections using a so-called toy model around various scenarios about what might happen and try to scale this against previous recessions and depressions for the world economy as a whole. And so you see that rendered in this rather busy slide. This is not meant to be a forecasting framework. It's meant to be just a kind of rough guide for creating a map of scenarios. And what you see here in the chart in the upper right-hand corner in the purple line is the Great Depression experience in the United States, So in the US, in the Great Depression, of course, there are many depressions in the US in the 1800s as well. The Great Depression was the worst of them all in the 1930s. And what you see there is that GDP shrank to 45% of its initial level. And it was a kind of double dip. It doesn't look like a W here because of the extreme nature of the downturn. But it took really a long time before the US emerged. And obviously there was permanent losses in output, and GDP never returned to the pre-depression trend line of GDP, right? The dark blue line at the top is the opposite case, right? That's what I think people are really referring to when they describe a V-shaped recession and recovery. And so that is the median experience of about 400 recessions over 200 years, short recessions in which, and here we've captured both growth and level, right? So it's a trend line of GDP relative to the baseline prior to the crisis or the downturn. And so what you see here is in the traditional V-shaped garden variety recession, you return to the pre-existing trend line after about half the cycle, right? After about 4 or 5 years. And so there are no permanent losses in output or in the level of GDP. And I think that's quite important because what that suggests is that in a normal recession, there aren't any serious problems, right? All the investment, all the debt that's been taken on, that reflected expectations that the economy would continue, one hopes, on the path that it had been on before the downturn. And indeed, that turns out to be the case. The green line in the middle is the median experience of countries that were hit by the 2008-2009 global financial crisis and the systemic banking crises that attended that downturn. And there you can see that despite all the monetary and fiscal support and bank recapitalization and so on that we had, GDP did not recover, right? And the gap between the baseline and the actual performance widened over time. So the trend growth rate was slower and the level was permanently lower, okay? And that, I guess, is what people mean when they talk about an L-shaped recession and recovery. Now, what we are expecting based on this kind of simple toy model, and I'll describe that a little bit in a moment, how we did that, what we're expecting is that this great compression will look and feel, it already does, like a bit of a depression, almost as bad as the Great Depression in the early phases, but then will end up being significantly better than a financial crisis, although worse than a garden variety V-shaped recession, because there will be, in our view, in all probability, there will be some permanent losses in output and a slowdown in the trend growth rate. And that is represented by the kind of fan chart of these scenarios that are in light gray and dark gray. And the dashed line is an intermediate sort of probability weighted scenario. Now, what we did here to construct this very simple model was to say, well, we don't really know how economies are going to react to this. There's no modern precedent and no modern guideline about how to think about this. So what we did was we took GDP as measured by end use, right? So not per the national account statistics, so not Y equals C plus I plus G plus X minus M, but how GDP is actually apportioned up by end use. So to give you a specific case, France, everybody knows France has a very large share of government spending in GDP, which is reckoned to be about 56%. But actually, a large part of that is public employees and public investment. So if you reapportion that to consumption, household consumption and corporate investment or government investment, what you see is that the operations of the French government are about a quarter of GDP, which is not that far off many other countries when you reapportion that way. So there are some similarities in structure across countries, but of course there are vast differences as well. So India has a very small public sector. China has a very large investment ratio. The US has a small public sector compared to some other rich countries and so on. And so then we tried to shock that level of GDP and trend growth rate by what we observed in the first quarter and gradually release the shock over time and see what that would do to growth over the next few years. And that's what you see in the right-hand side here. And what it shows you as a result of this rather mechanical exercise is that, of course, the fastest growing countries would suffer the deepest shock and would have the biggest difference to their pre-existing trend line, unless, of course, they respond with policy, which we didn't put into this model. And so India and China would suffer the greatest shock, and Japan would suffer, just simplistically, naively, arithmetically, the least shock. But of course, policy is going to come into play. And as I outlined before, national economic structures are very different, and policy responses and policy structure are very different. So performance is going to be very different, right? Even cyclically in this recovery, even as we all come out of this at more or less at the same time, even though we went into it more or less in the same way, we're going to come out of it quite differently. Okay, so switching gears a little bit from growth to inflation, obviously there's a great debate. Are we going to have inflation? Are we going to have deflation? Are we going to have stagflation because various kinds of trade barriers and various kinds of other changes are taking place that could adversely affect supply, even as governments are supporting demand? Well, so I would suggest that if we have an inflation problem or a stagflation problem, I would call that a quality problem, right? I think we know how to solve that problem. If we have inflation, we should tighten monetary policy and maybe tighten fiscal policy. If we have stagflation, the United States showed us in the 1970s how not to deal with that. If there's an adverse aggregate supply shock, you should tighten because you're going to get the inflation and the recession anyway. Otherwise, you're going to have to tighten quite a lot more later, as Volcker did in the early 1980s. So I think we know how to deal with that. I would suggest that for the foreseeable future, we are more in a disinflationary or deflationary camp as we have been since the GFC. And so I think it's no accident that today the Powell Fed is signaling a big shift towards average inflation targeting during the virtual Jackson Hole as a way of kind of continuing the forward guidance to try and keep monetary and financial conditions as loose as possible to support the recovery. Just a word on how we think these scenarios are going to play out in the different asset markets before we try to look a little bit at the longer term. So our asset allocation team ran these kinds of scenarios through and what they through their asset allocation optimization model. And what it shows is that there'll be a great deal of differentiation across asset classes. In a way, it's not really a surprise, but I think it's important and useful to know that what the models would show you is a great deal of dispersion in returns across asset classes. And the greater the range of scenarios, obviously, that you try to reduce, the greater the range of outcomes are likely to be in this kind of framework across asset classes. So, of course, this is what theory would tell you, but I would suggest that as a practical matter, we have not been living in this kind of universe for the last decade, right? For the last decade, we've been living in a world in which concentration made sense, not diversification, right? The US outperformed, it outperformed developed markets and emerging markets. The dollar was very strong, and various kinds of US sectors performed very strongly, right? So concentration strategies and high beta strategies paid off very handsomely in the last decade rather than diversification strategies. The rise of trade barriers, the rise of investment barriers, and the rise of the cyclical issue of diversity in national economic structure and in national fiscal policy responses, and to some degree monetary policy responses to the downturn and this great compression, all point, in my view, in this direction of great diversity in performance and in outcomes. Okay, so now let's try to think a little bit, bigger picture, broader brush about what we can glean from history and from the history of pandemics and the history of international trade and tensions in the geopolitical and geoeconomic area. So I would suggest the best precedent for today's pandemic is a century ago. It's the great influenza pandemic of 1918 to 1921, which was followed by the American Depression of the early 1920s. Right? And I think there's several important lessons from that depression, some of them somewhat random and some of them perhaps somewhat more cogent, that have some bearing on what the international system and the international economy might look like. So number one, the New York Fed has done some work that you may have seen, which shows that American cities that engaged in social distancing throughout the three waves of the 1918 to 21 influenza pandemic, the ones that did engage in social distancing performed better over the course of the pandemic and the ensuing depression than did cities that did not engage in social distancing. Right? So those that dealt with the public health problem, at least to some degree, performed better. So that's one important point, and I guess probably not surprising in a certain way, although President Trump would probably disagree. Somewhat more randomly, President Wilson was struck down by the Spanish flu and was unable to attend the peace talks at Versailles. And by many accounts, the result of that was that the war reparations that France imposed on Germany were much tougher than they might have been otherwise, partly in compensation for war reparations that Germany had imposed on France after a previous war, right? So as a result of that, you could say that one of the unintended consequences, perhaps somewhat randomly, is that Germany went into a very severe debt problem, hyperinflation, a deflation, fascism, and it contributed to World War II. Gandhi was also struck down in India by the Spanish flu. Of course, you may be aware that India had the lion's share of the infections and deaths in the pandemic. So it didn't really suffer that much from World War I, but it suffered some 50 million deaths from the pandemic. And Gandhi lost his voice, but he found this greater urgency in the struggle for Indian independence because he and many others attributed this terrible health outcome in India to what they called imperial indifference, right? So it intensified the struggle to kick out the British. And that, of course, led to a great deal of change, or at least contributed to a great deal of change, which was kicked off anyway by World War I in the international political system, right? And in particular, the end of British hegemony and the rise of American hegemony. Okay, so now I'm going to try to put this together with the so-called fourth industrial revolution of digitization and automation in the context of industrial revolutions that have been going on for the last century and a half, right? So I would suggest that these industrial revolutions are substantially about the relationship between capital and labor, not necessarily just in a Marxist sense, but in the sense of the so-called functional distribution of income, right? The share of GDP that goes to return on capital, goes to capital and profits, and that goes to labor income, right? So, of course, what all of these industrial revolutions have done in one way or another is to substitute physical capital and human capital for labor, for physical labor. And I suspect that the fourth industrial revolution is no different in that regard, although, like each of the previous ones, qualitatively different in many respects than the prior industrial revolutions, right? So we are in an era in which labor is under pressure, both because of globalization and because of technologization, as well as the pandemic. Now, what does this do to labor in terms of quantities of employment and prices in terms of labor prices or wages? So what the very long run history shows you here, this is US and the UK, two countries for which we have the best sort of comparable long-term data series. What the labor unemployment history shows you is that these industrial revolutions didn't really have that much effect on employment rates or unemployment rates, right? There were large variations in unemployment over time, but these were driven by cycles and shocks. There was no trend in the unemployment rate, and there was no big shift. If anything, particularly in the first and second industrial revolution, if anything, there was a bit of an increase in the average unemployment rate after the third industrial revolution in the 1970s began. Right? Now that I think is very interesting because that's when the United States and the United Kingdom both began to liberalize their labor markets. Right? So of course, theory would tell you, you liberalize your labor market, you make it easier to hire and fire, your unemployment rate should fall, not rise, if that's the only thing that's going on. Clearly something else was going on, and maybe we were already starting to get some of these issues of substituting capital for labor in different ways than had been taking place in the previous industrial revolutions. What about wages? Well, we all know and believe at least that the Phillips curve has flattened significantly. And so inflation and wage inflation, both the wage Phillips curve and the price Phillips curve, are much less responsive to unemployment now than they have been in the past. And this is from a chart from a speech by Andy Haldane, chief economist of the Bank of England, based on a millennium of macroeconomic data, a new database the Bank of England has for the United Kingdom. And very briefly, what it shows you here is that the wage Phillips curve in the United Kingdom today, and for some time, the green line is as flat as the wage Phillips curve was before the first industrial revolution, right? That's the gray line. So the wage Phillips curve is as flat now as during the later stages of feudalism and the development of bourgeois capitalism in the United Kingdom before the first industrial revolution, right? So labor is in a really weak position compared to capital, let's say. And of course, the evidence in the United States, as I think we all sort of know in one way or another, bears that out, right? That this phenomenon that had taken place in the 1800s in England has come to be known in the literature as Engels' pause, a pause in the matching of real wage gains with productivity gains, is very much manifest in what's happening in the labor market in the United States. The chart, in the interest of time, I won't go through this in too much detail, but just to show you the chart on the right-hand side shows you that if you divide up the US labor market by deciles of income, what you see is that income has been growing very much more slowly in the lower rungs of the labor market than in the upper rungs. And I would suggest that this problem is a lot worse than most people would seem to think, because the top 1%, which is the dark green at the top here, it's very volatile. Whereas the lower deciles, very flat, very gradual increases. So the top 1%, it's walking off with the lion's share, and you can see the volatility, the variability in that trend lines up with stock market cycles in the US. So, if you just think about it for a second, you can imagine why that would be the case. The top 1% of employees in the United States and in many other countries are paid in stock and stock options to a substantial degree. And those are being expensed and therefore accounted for in the national account statistics of the United States as labor income, but it's actually a return on capital, right? Because it's stock and stock options. So this problem of labor versus capital, and I sound a little bit Marxist here in this question of the functional distribution of income, of national income, is really heavily stacked against labor and in favor of capital. And I will try to link that together with the domestic and geopolitical changes that we are seeing in the world. These are two maps of the United States. The map on the left-hand side, map A, shows you the change in the Republican share of the two-party vote in general election 2016 versus 2012. And the map on the right-hand side shows you the change in the exposure to robots, also divided up by congressional district in the US. They're not identical, but they're very similar maps, right? And of course, we know that this is what President Trump exploited to barely win the 2016 election. And of course, I guess it hadn't occurred really to Mitt Romney when he ran against President Obama in the 2012 election and lost, right? So I think it's fair to say that these changes are significant. We've seen them before in the 1800s. We're seeing them again. They led to major changes, and they are probably contributing to major changes together with the pandemic and major changes in the international system as well. Of course, all of this is being bound up by President Trump in his anti-China stance and increasingly the stance of many other countries with regards to China. We'll see how all of this evolves, and the US election probably will have an important effect here. But I think it's fair to say that we don't really know what's going to happen. It really depends which way the US, which way China, and which way other major economies tilt, whether we go into a new kind of Cold War, as many people are saying, or whether we go into what I think is more likely is a more multipolar system. I think perhaps the better metaphor is not the late 20th century, but the late 19th century. I think it's a multipolar world because we don't really have the US and China, even though they're very large, standing so far above their respective client states or vassal states or whatever you might want to call them, compared to the US after World War II or Soviet Russia after World War II and during the Cold War, right? They are very much ahead of every other country in terms of size and scale and technological prowess, but not that much further ahead, I don't think. I think it's also a time like the 1800s because we're going through rapid technological change, much more rapid than most of the second half of the 20th century. And it's also a time of great globalization rather than great autarky. Although we may be shifting away from globalization, the status quo is much more like the 19th century than like the late 20th century. So I think everything that we're seeing points us towards an 18th century kind of world in which there were important flows of financial capital, physical capital, traded goods and services, and people across borders, which is where we are now. That may change to some degree, but I would suggest that's a better place to start to think about this than the Cold War, which began with the world already separated and much of it very heavily destroyed by the Second World War. Of course, the pandemic has created a lot of destruction, but it's not like a war, nor is it like a natural disaster, because productive capacity has been put on ice. It hasn't been destroyed. Demand has been compressed, but hasn't been destroyed in the same way as during the wars or during natural disasters, even though that kind of metaphor often leaps to mind. So I would suggest that, having said that, that there will be important changes that point us in a kind of 19th century, early 20th century direction in which we have a multipolar sphere of influence kind of environment in which trade and investment grow within spheres of influence, within regionalization of supply chains, localization of supply chains, rather than globalization, and rather than complete deglobalization. That's what happened in the interwar period when there was extreme rivalry among Great Britain, Germany, and Japan, with the US somewhat holding back as a somewhat isolationist country for much of that period. And I would suggest that that rivalry is going to continue to be all about world domination. This is a chart from the Angus Madison data set that shows you the share of world GDP going back to the birth of Christ. And what it shows you is that in the early part of the period, China and India dominated the world economy with regards to economic size, because until the first industrial revolution, most countries were pretty close to the technological frontier most of the time. So what made the difference in terms of their share of global output was demographics, essentially. That all changed with the advent of the United States, which is the dark blue here, and the several industrial revolutions that have taken place since that point in time. And what you can see here is that China starts to gain market share in world GDP as it goes from an agrarian economy, subsistence farming, and adopts the first three industrial revolutions. And this, of course, is why China is so eager to be at the forefront, at the technological frontier of the fourth industrial revolution, as is the US, and as Europe would like to be, as India would like to be, but probably don't have a chance. So I think this is what it's going to be all about as we emerge from the pandemic over the long run. And sort of the narrative that I'm suggesting is that we're going to have a great deal of diversity in both the cyclical recovery and in the longer term, because not all countries are going to be able to keep up at the technological frontier. Not all countries are going to be able to substitute for the imports fully that they stop taking in through the movement of supply chains and through the erection of these trade barriers and investment barriers. Why don't I stop there? I'd probably run over quite a bit. Apologies for that, and apologies for the technical disturbance. And I hope we can have a discussion around these issues.
Absolutely. Thank you very much, Arnab. I think it was very useful, very insightful. So I will start my questions. As you were presenting, and probably it's very related to what I do, and of course to the audience is, I mean, the case of emerging markets. So we are in a very emerging market economy. You mentioned that, for example, during the pandemic, basically we are, developed market economies have been able to expand their balance sheets in central banks, have been able to expand fiscal policy aggressively. We have seen some of that in emerging economies, but it's definitely much more constrained because of, I mean, it's difficult for emerging economies to get a lot of debt. also for their, just to have massive QE. They are subject to confidence, to a lot of issues, and they are more vulnerable to inflation than developed economies and to losses in confidence. So what's the way forward? I mean, how do you see, because you're talking about divergence, right? And this divergence is I think it's very relevant for us, and for the audience. This divergence between big economies, including China, of course, and emerging market economies.
Yeah, so I think you're absolutely right. The fiscal space and the monetary policy space is much more constrained in emerging market countries even today than it is in developed countries. But having said that, I would suggest that the Fed's success in stopping the surge of the dollar and in stopping the risk aversion has given emerging markets and the rest of the world as a whole a great deal more room than it might otherwise have had. So I think that is a rising tide of beta that has supported everyone in the markets, and I think it's a very good thing that the Fed has been able to do that, at least so far, both through direct increase in its own balance sheet and through swap lines and so forth. I think, having said that, I think that this problem of fiscal divergence is very important both in emerging market countries and in developed countries, right? Italy has done much less than Germany, even though Italy has done more than you might have expected. It's done much less than Germany. I would say Brazil has done much more than India. Mexico has done much less than Brazil. And we will see how this all pans out. But I would suggest that the problem of public debt in this environment of extremely loose monetary policy and financial conditions, very easy financial conditions, is much less of a problem than it would otherwise be, for the simple reason that the private sector is saving a lot more, right? Households are saving a lot more, corporates are saving a lot more because they've been subjected to an extreme, unprecedented, unexpected shock. And because in many instances, they've been supported in doing so because they can't spend. And because in many countries, not all, but in many countries, they have had some transfers. So I think, the overall environment is one in which we have a shortage of investment and an excess of savings. And that accounts for the rise in the output gap, in a literal sense accounts for it. And that points to a disinflationary outcome rather than an inflationary one, in my opinion, at least for the next few years. And that is an environment in which the policy space exists to pursue some changes country by country in the structure of what's going on, right? I think some countries can use this, if they can bring themselves to do it, countries can use this opportunity to do a lot more structural reform and liberalization. I know it sounds probably like the same old neoclassical mumbo jumbo that not everybody is willing to take on board right now. But I think the countries that do that, and of course some countries are grappling with that idea, including in Latin America, including in South Asia and Southeast Asia and in Africa, if countries can bring themselves to do that, even in the midst of trying to create a kinder, gentler kind of capitalism, I think the market will respond to that and will respect it. Right? I think the general trend that you would expect to see after all these shocks that we've experienced in the last decade, right? The global financial crisis, the Eurozone crisis, the Chinese devaluation of 2015, and now this pandemic and this compression, these things, naturally perhaps lead one to expect redistribution. I can see the argument, and I'm sure that will be necessary in many places, right? But I would suggest that the prize will go to those countries that can do what is necessary to support households and to support labor, but not to protect capital, right? To make a competitive environment to encourage investment and to encourage high returns on capital, because that's what would work in a world starved of growth and yield and hungry for at least some inflation. And if that is done, then I think corporate investment, capex, domestic and foreign, and financial investment would respond positively. So I don't think it's just about the fiscal space or just about the monetary space. It's about the question of what you do as a policymaker and as an investor to take advantage of this situation to try and make things better for the long run, which is really more of a structural question and a political economy question.
Mm-hmm. Well, thank you very much. I think it's probably going along those lines, and regarding what you just mentioned, that the fiscal and monetary space, what we will see at the end of this pandemic is quite unprecedented. I mean, we will end up with a very, very huge debt, the levels of public debt, huge central bank balance sheets. And we haven't seen that. I mean, given that, of course, you make a lot of references to history, and I think it's quite relevant to see how we can apply any lesson, because it seems like actually quite unprecedented. All of the world at the same time having the same crisis. How are we solving this issue in the long term? Is it reflation, as you mentioned? Is it higher inflation? Is there any other way? Or actually, if you see, because in a way you're optimistic in the sense that you're expecting governments to make the right decisions, but you also mentioned during your presentation that we may see a lot of political changes from this pandemic as we saw in the past. So how do you put all that together? I know it's very challenging, but how do you put all that together?
Listen, of course, I know the perfect answer, but I'm not going to tell you. No. I think it is, kind of the, I guess, the $100 trillion question now. I guess my answer would be that, number one, if this hadn't been done, if we hadn't put this public sector balance sheet to work, what a terrible outcome we would have had, right? We would have had this compression would have become a depression. We would, I think, certainly have had cascading financial crises, cascading defaults, and a downward spiral. It would have been very difficult to deal with. And I think that's what we were looking at, that we were looking over the brink of that in March, right? And I think putting the central bank balance sheets and the public sector balance sheets there in the way was absolutely the right response, even though it leaves us with this unprecedented problem. I think the only way we're going to be able to deal with this problem is to stretch it out over a long period of time, perhaps over a generation or more. I think we're going to have to see, probably an important increase in taxes of various kinds. The whole kind of stagflation, inflation, deflation question is, how do you distribute this burden in a way, right? If you opt for deflation, you're going to do this by deal with the burden of these problems by having cascading defaults and penalize creditors directly, creditors and shareholders directly. If you somehow manage to generate a lot of inflation, whether you do it through financial repression, or maybe if you can do it through pretending somehow that inflation is lower than it actually is, then of course you're doing this in a very regressive way and taxing labor indirectly, which many countries have done, including in Latin America, over long periods of time. I don't think globally that's where we're headed because of the pressure that has been there on labor relative to capital over a long period of time. So I think where we're headed is that we will deal with this problem very slowly, very gradually, and by somehow redressing the balance between labor and capital through taxes on corporations, taxes on indirect taxes on wealth, or corporate income taxes or shareholder income taxes of various kinds on those who have in favor of those who have not as much. Right? Now, I don't think there's going to be a financial crisis. It can't be ruled out, but I don't think there's going to be a financial crisis either related to high inflation or deflation, for the simple reason that no one country, just what you said, right? No one country is doing this themselves, right? This is not like the enormous debt burden that was placed on Germany as a result, or whatever other country you want to say, because of the wars, or because of domestic decisions, as was the case in some of the other classical hyperinflations, right? Every country has this problem. So it's not obvious that there's a place to run and hide from this. You could say China is doing much less of this than the US or than Western Europe or than Brazil. And that, of course, is true. But of course, China already has a much higher level of overall gross national debt than other countries. Of course, it's in a better position to finance that because it's got a state-owned banking system, it's got capital controls, it's a net creditor, and it has still a current account surplus. So I think, despite the fact that everybody is in this together with very similar, with the exception of China perhaps, with very similar shifts in their gross national balance sheets, there are all these differences still that I think will make a difference, a big difference in the long run, about how fast this problem is dealt with and how that problem is distributed across different segments of the population and with the rest of the world, right? If that's clear. So I think the diversity argument still holds up there, even though there's a shared balance sheet problem, as you say, across countries.
Great. And one thing, before moving on to the questions from the audience, I wanted to ask a question about lessons. I mean, investment lessons, of course, and that's what you do. I mean, you work with investors. And most of the investors in the audience are official institutions. So how should they think long-term about their portfolios, given all, these very complex and unprecedented environments?
Well, so I think, one of the general lessons of these kinds of major shocks and crises is, which I think will be very familiar to many official investors, including those in the audience here, is that, typically you see a period of increase, sometimes quite a long period of increase in so-called self-insurance, right? So with financial crises that take the form of currency crisis or balance sheet crisis, balance of payments crisis, you tend to get an increase in international reserves. Well, I think we have seen in some of these sorts of crises in the past that you get a kind of similar behavior at the household level and at the corporate level. You see households increasing their savings rates and building cash buffers. You see corporations doing the same thing in the wake of the GFC and the Eurozone crisis. I think you are seeing some of that already, and I think you'll see some more of it in this case, right? And I think there's a danger, of course, that if savings rates continue to be high or rise further from here, that we'll all be in this kind of Keynesian idea of a paradox of thrift. And so, of course, governments will need to respond to that, and they'll do that by further increasing, in my opinion, their debt issuance and their balance sheet size in order to keep the show on the road or get it back on the road. I think it is an environment. I've espoused some interesting and hopefully strong views, but of course it is an environment of great uncertainty, and it's an environment of uncertainty on many dimensions, right? Growth, inflation, deflation, stagflation, geopolitics, geoeconomics, everything is uncertain. It's also uncertain how some of the issues that have been exposed in domestic economic and political models and public health models is going to be dealt with, right? So it's clear that the US was relatively unprepared for this kind of a problem, that the UK was relatively unprepared, Germany perhaps better prepared, many parts of North Asia better prepared, India 100 years later still woefully unprepared, Latin America would say on average relatively unprepared. So there are going to be some changes in domestic political economy and in the relationship between the state and the provision of various kinds of services, which could be public or private, including health and insurance. So I think that all implies that the role of the state will change. On the international front, these uncertainties will continue. And I think here on both of those fronts, the portfolio implication is that there are benefits to hedges and to diversification, as I said before, right? So the concentration strategies that worked so well over the last decade, right? Sort of risk on, risk off as a trading strategy, just a beta strategy essentially, and a concentration sort of momentum strategy in the tech sector, in the US equity market, that may have helped to maximize returns and still seems to be the right thing to do, given the response of the Fed and the importance of technology in dealing with the pandemic. But I think if you look out over the horizon, the uncertainties speak to an important role for gold. I'm not a gold bug, and I wouldn't suggest we're going to go from a fiat currency system to a gold-backed system. But I do think that in this environment of rising uncertainty or high uncertainty and rising geopolitical tension, central banks, sovereign wealth funds, and so let's say ordinary private investors are going to continue to allocate more towards gold. Now, it has to be said, of course, that the price of gold is high, that the performance of gold over the long run tends to be quite volatile. And so it's not kind of obvious go-to place. But I do think that it's clear that gold has tended to outperform, or at least let's put it this way, it has tended to generate positive returns in all kinds of macro regimes, deflation, high inflation, and even in normal times, as long as the price of gold wasn't controlled or its availability wasn't controlled or both, because it was the core of a monetary system, right? So as long as we have a fiat-based monetary system, I think it makes sense with this uncertainty to have something of a hedge against deflation or inflation risk, geopolitical risk with gold, as well as with diversification across the financial space.
Excellent, thank you. So we're going to continue with questions from the audience. First, I'm going to make an announcement that we're going to go 5 minutes past the allotted time, also to compensate for the technical glitch. So this question is from Omar Mendoza from the Central Bank of Venezuela. I think it's related to what you mentioned in terms of labor, the pressure on labor. So do you think that it's possible in the post-COVID world, structural changes in labor relationships and inter and intra-company dynamics become evident?
Yes, I think you could well see a much greater emphasis on what I call a kinder, gentler form of capitalism. Right? I think we have already seen indications of that from many different countries prior to the pandemic. Right here in the United Kingdom, where I live, there's been all this discussion about leveling up left behind regions, right? About shifting public investment and trying to induce corporate investment into areas of the UK that have been left behind by globalization and by integration of the UK with the EU and with the rest of the world. Now, I think it's very easy to say this sort of thing. It's much harder to do it. Latin America, many countries, you'll all know much better than I do, that have pursued so-called local locational strategies. One of the reasons that Brasilia is where it is just that. That's been pursued in many places over long periods of time without necessarily working very well. So I would hope that governments don't go too far in this direction, but I think that's one part of the story that is emerging. And I think you'd say China, is doing this or trying to do this. One interpretation of what's going on with the Belt and Road Initiative is just that, right? Is to move the prosperity from the the eastern coastline of China towards the western hinterland, which has been relatively left behind. China is really a high-income country on the coasts and a low to middle-income country in the interior. So there are many countries, capitalist and not so capitalist, that are pursuing this. So I think public policy is going to pursue that sort of a change. And of course, in the U.S., even in the U.S., you see that that's part of Trump's political agenda as well as part of his political appeal. So I think you're going to see that from public policy. And I think where public policy goes in that direction, and where private investors are concerned with ESG, concerned with principles of trying to do the right thing vis-a-vis the environment, vis-a-vis the social conditions and the inequality problem, as well as the general governance issues that we all face, I think there's clear sort of reputational pressure in that regard as well. So there is a debate about having more representation for "quote unquote" labor on company boards as per the German model. Is it going to work in the Anglo-Saxon world? I don't know. Is it going to work in the emerging markets? I don't know. But I think that we're going to move in that direction. I would suggest the market will discriminate between those countries that provide support to labor without providing excessive protection, right? It's critical to get the incentives right. And we've not been in a world, I think, where we've been focusing on those kinds of issues. We've been focusing more on sort of macro issues, but these kinds of somewhat more micro issues, I think, will come more and more to the fore, and will have to be factored into the thinking of companies and the thinking of financial investors.
Excellent, thank you. And then we have one final question from Gustavo Smokovic from Unicare. The question is, what's your long-term expectation about the US dollar as a world reserve currency? Do you think there's really no alternative?
You know, Charles Kindleberger once said that in the beginning and the middle and the end, there was the dollar, only the dollar. And I think that's where we get the phrase, the almighty dollar. I think, you know, right now there is no alternative, and there's no obvious alternative visible on the horizon, in my opinion. You know, the euro could be an alternative if they continue to move in the kind of Hamiltonian direction that they've set off in with this fiscal integration effort. But that effort, even though it's been called the Hamilton moment, is well short of having anything comparable to what the US has as a safe asset, right, in treasuries. You know, you still have the question about whether this will be reversed, whether it will be required to do another major step the next time there's a crisis, and whether that will happen. So I think the euro is moving in that direction, but it's not there yet. The renminbi is an obvious alternative, and the Chinese state has tried to make it more of an alternative than it has been in the past. But you still have a problem, right? You still have resident capital controls, even though the border is becoming more open to two-way flows by non-residents. Now, the renminbi, I guess, is the clear alternative. And I think if we do get more of a bifurcation in the international system, you will see the renminbi playing a larger role. And it's conceivable that it could do that as an international currency, even with a separation between the domestic monetary system and the international monetary system, right? There is a precedent for that. The Soviet Union had that. It had a ruble that was used internally among the Soviet republics as a kind of normal legal tender, you know, within the context, not normal in the sense it wasn't a market economy. A lot of the prices were fiat prices. But you had a fiat currency there within the Soviet Union. And you had a separate international ruble called the clearing ruble that the Soviet Union used with many countries in Africa and with India, or with, you know, parts of South Asia, especially India. So there is a precedent for a transaction, denomination, and reserve currency that is separated from the domestic currency. But of course, that was necessary and possible in a system that was bifurcated between the Soviet part of the system and the Western part of the system. So participants in that system had both sets of currencies as assets and liabilities, at least to some degree, had both the dollar and sterling and Deutschmark and so on, as well as the Soviet clearing ruble in some cases. Would that really substitute for the dollar? I guess you could see it as more of a complement rather than a substitute. Now, will we have some other form of currency if we go back to gold? I guess it's possible. I don't think so. I think it's clear that financial systems and monetary systems are way too big and way too complex to be left, you know, to the kind of vagaries of this barbarous relic. To kind of, you know, go up and down. And it's not clear that you get better results. You may have more, you know, quote unquote, price stability, but you also got quite a lot of asset price bubbles and quite a lot of deflations of those asset price bubbles, and eventually actual deflations, even in the gold standard. So I think, you know, we're not going to go to any of those kinds of extremes. And I think the dollar is here with us to stay for a very long time indeed, for most of the world.
Okay, Arnab, thank you very much. It was a great discussion, and definitely leaves us with a lot of answers and a lot of questions. Thank you very much. So over to you, Iker. Thank you.
Thank you, Marcos. Thank you, Arnab. Well, what a session indeed. Very complex and challenging times ahead of us. Once again, I would like to extend our deepest gratitude to our guest today, Arnab Das from Invesco, and to our host today, Marco Ruiz from the RAMP program at the World Bank. Many thanks for your insights today. I am very certain that they will greatly contribute to and add great value to the investment of public resources of our institutions. Also, I would like to very specially thank all of you, our audience today, for accompanying us once again. About our next session in September, we will be hosting our 6th edition of these Cartagena Talks. We will be accompanied by Frank Kelly from DWS, who will be taking a closer look at the United States presidential elections and the perspectives and implications associated with such a crucial event. We hope that you can accompany us once again. Until then, so long, stay safe, be in peace. Hasta la vista, amigos.